This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on Early Warning Indicators. This chapter is taken from a textbook with the title Liquidity Risk Management, and I urge you guys to go ahead and look at the source material and read the first paragraph of this chapter. Now, I'm paraphrasing here, but it reads something like, bank leadership has the responsibility to identify and manage the underlying liquidity risk factors. And when you read that, I want you to think to yourself, oh, I've heard something like that from Jim at least 1,000 times. But I also want you to read the next couple of sentences and the next paragraph. The authors talk about how some of these key aspects are to anticipate these liquidity events. And so that's why this chapter is called Early Warning Indicators. And so that's what we're trying to do here. Anticipate some kind of a liquidity event. Only 3 learning objectives. Evaluate the characteristics of sound early warning indicators. All right, that sounds an awful lot like anticipating. And then let's go ahead and look at some guidelines from some really smart people who are out there working inside of our firm, working for the government, working for some kind of regulatory agency. And then we'll kind of summarize that in the context of liquidity risk in the last slide or two. Those of you who have looked at the chapter will know this is a pretty short chapter, so the slide deck is pretty short as well. So let's go ahead and look at some basic early warning indicators. All right, so what do we have written in that first block point? Changes in key metrics, and we'll talk about those here in just a second. That forecast and signal disturbances. I mean, that makes perfect sense in the anticipatory framework that I just described. Notice we've got the alarm bells over there. All right, so what do we know? We got to have our brains open. We have to have our ears open. And we have to have all of our other senses open. And so here's what I like about this. So that these early warning indicators, of course, being technical people, we like the quantitative early warning indicator, but there are also qualitative early warning indicators as well. So this is what I've said to you in the past, kind of the marriage of technology with an artistic ability to be able to, feel or imagine or touch, with one of your senses that say, okay, I don't really have a number that I can assign to this, but I have a feeling. When you watch detective movies or you read a detective book, the detectives always say, oh, I have a hunch, and then the hunch either plays out or it doesn't. But that's kind of what we're talking about here with these qualitative. But of course, hunches have to be supported by not only quantitative variables, but other things as well. So look at the last couple of circle points there. So an urgent problem, a potential problem, or some issue that warrants further analysis. All right, let's directly address that first learning objective. Characteristics of sound early warning indicators. All right, comprehensive, which means we're going to look at the financial statements, right? Particularly the balance sheet, but we also want to look at all those off-balance sheet items, things like special purpose vehicles and the like. Forward-looking, of course, information that provides information on potential stress prior to the occurrence of an actual event. Go back to when you watch business shows on television and an economist will be on. They always have leading indicators and lagging indicators and coincidental or coincident indicators. And so, we want to avoid those lagging indicators. This should be forward-looking. Sufficiently granular, of course, you can look at, like for example, if you go to Yahoo Finance and you just click on, any company like Johnson & Johnson, you get a balance sheet and you'll see like current assets and long-term assets. But then there's a click over there that you can get more granular and you can see the entire list of those. So we want to make certain that we look at a low enough or a granular enough level so that we can identify potential liquidity problems. What's the example that we've come up with there? A report that reveals an overall decline in deposit balance is helpful, right? It's helpful, overall decline, but let's go ahead and break that down into customer segments, because it might be that one segment is increasing their balance and others are decreasing their balance. So granularity is important. Spanning various time horizons. We've talked about this many times in the past. Do you want to do this every minute of every day? Well, that sounds like a lot, right? So do you want to do it daily? Do you want to do it weekly? Do you want to do it monthly? Clearly monthly, probably weekly. And, if you have your ears open every day, then you'll probably be able to catch these early warning indicators. And then, of course, we're going to examine these potential liquidity events both during normal economies and then stressed economies. And then that, of course, leads into the normal economy for our particular financial institution and a stressed economy for our particular financial institution. Remember, we could be under stress, but the entire banking industry could not be. Here's a list of some good examples. I would go ahead and, I always hate to tell students to memorize stuff, but these things probably are good indicators. And as I'm thinking of good exam questions, I can see a question stem where you're given a bunch of stuff from a financial institution, and then one of these shows up, or two of these shows up, or maybe four of these show up, and only one is an example of an early warning indicator. So let's think about this. Let me go through these relatively quickly. Rapid asset growth. This is a good thing, right? What do we want the left-hand side of our balance sheet to do? We want the left-hand side of the balance sheet to grow because, now let's make certain, hopefully the bottom right-hand side of the balance sheet is growing. What's the goal of any business? Maximize shareholder wealth. So we want to swell that equity portion of the balance sheet, which that then translates over to growing assets. However, of course, with the financial institution, we have to be careful with what happens at the top right of the balance sheet. So look at the last part of that first block point, especially when funded with probable volatile liabilities. All right, growing concentrations in assets or liabilities, increases in currency mismatches. And so here's part of that currency mismatch. For bank holding companies that have offices all throughout the world, dealing in different currencies every day, you're bound to have currency mismatches both on the left-hand and the right-hand side of the balance sheet. And so layered on top of all this is how much of a reliance does the institution have on things like forward contracts? Of course, all financial institutions use currency forward contracts, but then, are there futures contracts in there? Are there options contracts? Are there some other kind of a swap contract or a derivative contract that seeks to resolve those currency mismatches? A decrease in the weighted average maturity of liabilities. This goes all the way back to, our regular old sound asset liability management. So of course we want that weighted average maturity, and we want the weighted average duration. Don't forget about that. And then in some cases, if there are embedded options in some of our liabilities, we want to know about convexity as well. Breaching internal or regulatory limits. All right, so recurring incidents of these kinds of positions. Excuse me. Negative trends associated with a particular product line. Suppose no one is buying our certificates of deposit because the bank down the street is offering a slightly higher interest rate, or maybe more favorable terms. Credit rating downgrade, but also the perception of a reduction in credit quality as well. So look, we can, here's where you get to that quantitative and qualitative. Of course, you can see, everybody can see if there's a credit rating downgrade, but not too many people can see the potential for a downgrade. So you got to worry about that, kind of a loss in confidence before the actual downgrade occurs. Stock price declines, bond price declines, drop in credit lines. Retail deposit outflows, if those things are increasing. increasing redemptions of CDs before maturity. So those three, they kind of go hand in hand. Difficulty in accessing longer-term funding and placing short-term liabilities. So those bottom two, can kind of be summarized in thinking about how much quick and how much of an ease do we have access to capital markets. Now, how about some guidelines that are offered by some of these regulatory bodies or government bodies that, these people, they're out there trying to make life better for financial institutions and provide stability inside of the industry. So let's look at the Office of the Controller of the Currency. So this goes all the way back to 2012. So these early warning indicators should exist for all products with embedded options. Boy, I just said that a few moments ago. So that's really important. Of course, these embedded options, a lot of times they're out of the money, but as soon as they hit near the money or they become in the money, then this is going to rearrange, perhaps both the left-hand and the right-hand side of the balance sheet. So here we've got to anticipate those interest rate changes so that we know what the consequences are going to be, and then have a plan in place if interest rates move against us, at least in terms of those derivative products. All right, so here are some good examples. This is a great items that could show up on an exam. Change in terms, stringent long-term debt requirements, spread increases, right, higher borrowing rates, and then, what about these ratings downgrades? What about, capital asset quality, et cetera, et cetera. I think we call those the camels. How about some other guidelines that are out there? Boy, and these are repeated. Look, very rapid asset growth, growing concentrations, currency mismatches, lower liability durations. We talked about the maturity just a minute ago, and I mentioned duration, and don't forget convexity in there. That might not be a part of the learning objectives. It might not be part of the chapter, but just for regular lifetime kind of knowledge, when you think about duration, that's the first derivative. Then think about convexity, that's a second derivative. A lot of times convexity doesn't matter, but sometimes it does. So you need to anticipate, the fall in the value of a bond portfolio because of convexity issues. How about some updates then in 2012? So the green goes back to 2008. So then there were some updates. Concentrate on intraday liquidity because, think about what happened between 2008 and 2012. Intraday, so maximum liquidity per day, available intraday liquidity, intraday lines of credit. So let me go ahead and just remind you that when we had that one slide a few back, we talked about, the timing of this. Do we want to do this monthly? Of course we want to do it. Do we want to do weekly? Yes. How about daily? Well, some days you need to, some days you don't. But as long as we're aware that today might be the day, I think that's what these guidelines address. And then how about what the Fed thinks about all this stuff? Impending constraints on liquidity. I love this term, constraints. This goes all the way back to, the stuff that we learned in investments class regarding investor constraints. So now we're flipping that. What about financial institution constraints? And let's go ahead and look at some examples here as it relates to liquidity risk, negative publicity, worsening of the bank's balance sheet, and increased spreads. So the Fed doesn't really add a whole lot to what we've talked about in those previous couple of slides, but here are those points of emphasis as the supervisory body that it is. All right, how about applications in the context of liquidity risk management? All right, so escalation, reporting, and integrated systems. Escalation. All right, so they can form the basis of the escalation of an issue to senior management, right? So this, remember this, we got this big umbrella here. So these senior executives are relying on each of these silos to anticipate. All right, so we have all these individuals anticipating. We have these groups of individuals anticipating. And so once one of these signals hits, then it gets the appropriate level of attention and response. It's not sufficient to just say, oh, look what's happening over here in our derivatives trading unit. Boy, let's go to lunch. I mean, we need to say, all right, let's go ahead and respond. Let's pay way more attention to it. And then let's make a plan for what happens, tomorrow or next week. Of course, reporting is a big deal. We need to respond in a timely manner to minimize the damage. And I'm in favor of responding in a timely manner to all events, positive or negative. But if we have some kind of a liquidity event or some kind of a downgrade in credit quality, we don't want to hide it. In fact, we want to get it out as quickly as possible. And then integrated systems. Of course, all I think about when I hear that term, integrated systems, I just think of a bunch of wires. I know this in my small brain. I just think of like a bunch of wires. Like you ever see that great movie, The Martian, where the one guy is in this big computer room and he's running a process to see about gravity and the moon and Earth and Mars and all that stuff. And I just think about all these wires and fiber optics. So, what does this say? No signal goes unnoticed. So I'm guessing in financial institutions that this is probably not too much of an issue. How about thresholds? This, give the Fed and give these governing bodies, kind of credit before the 2020 COVID scenario where we had economies, in red and yellow and green. The industry was on top of this a long time before COVID. All right, so green, an event requires no further action. Amber needs close monitoring. Red means, hey, let's stop and we need to figure this out. Yeah, notice this part here, industry practices, and this is an interesting series of an interesting series of paragraphs inside of the chapter. Let me go ahead and read that first block point to you. These early warning indicators have improved risk management across the banking industry as a whole, and then monitoring the health of individual banks more closely. So look, this goes back to what I said to you guys, the very first lecture, the very first recording, identify the risks, quantify the risks, and then manage the risks. And of course, when you have everybody using that model, then, boy, can I read that to you again? EWIs have improved risk management across the banking industry. Of course, it would improve risk management across the banking industry if everybody is thinking of those steps. And that takes us through this pretty short slide deck and recording. Boy, I'd hate to assign greater probability of any one of these. But look, I think the great exam question is to give a scenario where you have a financial institution and there's some bullet points about indicators. Some of these will be positive and maybe one of them will be an early warning indicator. So I'm guessing that's probably at least a little bit more important than the others. But then, you skip down to that third one in the context of liquidity risk. This just goes back to what we've talked about many times. Identify, quantify, and manage.